What do you think are some of the key factors for investing in US equities?
There are tech companies in the US, the likes of Meta, the likes of Alphabet. The only way to invest in them is through the US market.
The Indian rupee depreciates at an average of about 4% against the USD. How does this impact equity investments in the US?
I think
Neil Borate is the personal finance editor at Mint. With over 9 years of experience as a financial journalist, he simplifies complex financial topics for Indian readers. Today, he is here to discuss the growing interest in US stocks among Indians and key factors to consider before investing.
in the US there is no concept of demat account. Your money is held by the broker, and if the broker goes under, it's not segregated. Good part about the US market is it's like the mother market. One US market will give you that global access.
So let's talk about an individual who wants to capitalize on this tech boom. How does one really go about it? So Neil, let's just set the context. The fact that we've seen India's outward remittances hit a record of nearly $31 billion in FY24. That's been a nearly 17% jump. What do you think are some of the key factors that is fueling this growth of investing in US equities?
Sure. So we put out actually a asset return quilt every year at the end of the year that gets a lot of traction. And in that we compare different asset classes. So everything from Indian large caps, mid cap, small cap, gold, and US equities is a part of it. So in the calendar year that just ended, actually the top performer is the S&P 500 converted to rupees. Like we talk about the mid and small cap boom, and that undoubtedly happened. Like they are number 2 and 3. But if you just compare index to index, S&P in rupees is actually at the top at around 27% return in 2024.
That's actually pretty interesting, the fact that it is the top performer at a time when we're looking at our own markets as well skyrocketing. Any other factors that you think is fueling this growth? Anything from a macroeconomic perspective as well that you'd like to add?
Yeah, there are two things. So one is that the rupee depreciates against the dollar on average by about 4% a year. So that lifts all US returns. The other is that there are tech companies in the US which we simply do not have in India and which we may never have. The likes of Meta, the likes of Alphabet. So the only way to invest in them is through the US market.
Okay, so let's talk about an individual who wants to capitalize on this tech boom in particular, who wants to take part in this rally. How does one really go about it?
So until recently, and when I say recently, I mean probably until 2022, the best way was through the mutual fund route because there were so many feeder funds investing overseas. Then in 2022, the entire mutual fund industry hit the RBI limit, $7 billion. And they now accept some money. So if there are outflows, they reopen for a little bit to cover up that gap. But by and large, they don't accept money. And we've now reached a point where some of these ETFs are trading at a premium, a 10%, staggering 10% premium. The most famous one is the Motilal Nasdaq ETF. People are willing to pay 10% more just to take exposure to the US. So now, really, the only possible practical way is to remit money to a US account, US brokerage, through the liberalized remittance scheme of the RBI. You're allowed to remit up to $2.5 lakh each year. Now, this is of course subject to TCS or tax collected at source for any amount that exceeds 7 lakhs. But that is just a tax collection. It's not a fresh tax that's imposed. So you can set that tax off against your overall tax liability. All it does is it creates a cash flow issue because upfront you have to pay this TCS and you claim it back when you file your return.
Okay, so just if we could break it down a little bit further. So now say I'm looking at remitting money. You've given us the limit, which is $2.5 lakh per year. What is the first step, or what does my checklist look like in order to go about this?
You have to first identify which broker you want to use in the US. They need to be well established, sound, not somebody who might go under or who might do some shady practice. And then you have to figure out how much of your portfolio you want invested in overseas stocks. So typically for people who have kids who will study abroad, they would want a higher percentage. Um, but definitely, I mean, most people are so overwhelmingly exposed to India and have so little money outside that,
Yeah.
and it's so much at odds to the global market cap. Like if you think of the entire world as a pie, US right now is 70% of that pie. India is, in single digits, yet most of us have more than 90% of our exposure to the Indian market.
Yes.
So even if you don't have kids going abroad, it makes sense
Hmm.
to have a significant amount invested overseas. So that's the second thing, to decide how much of your portfolio should be there. And then third thing is that where would you invest it? Would you buy ETFs, stocks? Who would you get advice from?
Okay. Let's understand how other countries as well is it more receptive to investing in US equities as compared to India? Where do we stand on that scale?
So the good part about the US market is it's like the mother market. They have ETFs that invest in countries around the world. So you don't have to really open an account also in Germany or UK or Singapore. One US market will give you that global access. Not only if you just buy the S&P, because a large part of the S&P's revenues, S&P 500's revenues come from around the world. So that's one very quick and easy way of getting global access. That's the other way is that you can also buy ETFs of countries that are significant. So let's say you're bullish on China. You can buy an ETF in the US that invests in China or Brazil or any other country that you're interested in.
Most important question, I think, which is everyone will want to know. What are the tax implications? Dual tax compliance. Recently, there was that 20% tax collected at source as well on international investments. Just break it down for us.
Sure. So the first tax you face is that 20% TCS on the remittance above 7 lakhs. The good part is it's just tax collection. It's not a fresh tax. So you can adjust it against your overall tax liability. And if there's too much tax you paid, you just claim it back when you file your income tax return. The second tax is on dividends. Now, the US has a 25% withholding tax on dividends. Now,
Okay.
thankfully, there is a US India Double Taxation Avoidance Treaty, or DTAA. So you can claim that withheld tax in your Indian income tax return.
Okay.
The third is capital gains. So when you buy and sell your stocks or ETFs in the US, you're liable for tax on those in India. And in this recent budget, they have actually made it simpler.
Okay.
So after a 2-year holding period, they are subject to the same 12.5% long-term capital gains tax as a domestic stock would be. So literally, it's just one more year you hold it and you're at par. And you would pay tax on it in much the same way as you would pay tax on domestic equity. Advanced tax dates, you would pay it in equal installments.
So just correct me if I'm wrong. When it comes to investing in US equities via these routes, there's that perception about this dual tax compliance and all of it being a little bit unnerving and shelling out a lot. What is it, if you can just chart out for us in comparison to investing in domestic equities versus doing it overseas, and how much more or less or as much are we paying?
Yes. So yes, the compliance is more because your investments abroad, whether they are in US stocks or property or anything, or even a bank account abroad, is subject to the provisions of the Black Money Act. Now, this is a very, very severe piece of legislation. And basically, under this act, if you fail to report your foreign income or assets, then there are not only enhanced penalties, but there is prosecution with very heavy jail terms. So this was a hanging sword on a lot of investors who, for whatever genuine reason, might have missed out on reporting some income or asset abroad. Now, thankfully, again in this recent budget, the finance minister has given a somewhat reasonable limit, up to 20 lakhs. If you miss out for a genuine reason, then ordinarily they will not impose a penalty on you. But still, it is really important that you don't make any of these misses. You do report everything, not only in the ITR, so not only in the income section where you're saying, let's say you have 4 lakh capital gain on Apple stock, but also in a specialized part of the ITR called Schedule FA, Schedule Foreign Assets, which has a format. So you have to mention the date of acquisition, where the account was held, the date of opening the account. There's a whole set of things you have to fill very, very correctly.
Okay, so it's a long, the compliance has to be absolutely 100% foolproof.
Oh, yes.
Okay. Can you tell us a little bit more about what is the profile of a typical investor to invest in equities in the US?
So normally, this comes into the radar once you've built up a certain amount of assets in India.
What's
Uh,
certain?
so again, maybe rule of thumb, I would say more than a crore. If your portfolio has attained that size, then you would want to diversify.
Okay.
And also, if you have kids who are going to study abroad, then especially it makes sense
Okay.
because the costs are not trivial because there are forex. So when you send money abroad, there is forex conversion cost. You have to deal with all this additional compliance. There will be brokerage charge in the US. So it's if you just have a 10 lakh portfolio, it doesn't really make sense.
Ah. Now, if I have that 1 crore portfolio and you're saying, yes, it makes sense to diversify, especially if I have a child who's studying abroad, you have also, spoken of a number of penalties. Are the pros outweighing the cons? Because yes, of course, you are getting bang for your buck, as you said, but run us through the pros and the cons.
Sure. So the two pros, I would say, one is the currency uplift that you get, 3 to 4% a year. And of course, you get exposure to these powerful tech companies that are only there in the US. The two cons historically were quite severe in terms of penalties and non-compliance, but that relaxation in the budget, up to 20 lakhs of non-reporting, that they won't normally impose a penalty, that's a big one. And the other is the bringing it on par with domestic equities after a 2-year holding period. That 12.5% tax, that's quite a big one. In fact, we've reached a situation now where if you invest in a debt fund in India, you are paying tax at slab rate regardless of how long you hold it. But if you invest in a bond ETF in the US, you're going to pay 12.5% after 2 years. So it's actually more favorable now in some respects to invest abroad.
Okay. What about factors like currency fluctuations and brokerage charges? You were just stressing on the importance of a broker. How does one even go about that?
Yeah, and that's especially important because in the US, there is no concept of demat accounts. Your money is held by the broker, and if the broker goes under, it's not segregated like it is in India. Of course, they do have insurance.
So if the broker goes under, what happens?
Your money is gone subject to some provisions. So they do
You sound
have
very calm saying that.
So it is now they have a very good SEC is quite a good regulator and it's a very rare occurrence.
It is.
And they also have insurance. So they have this thing called SPIC where up to, if I remember correctly, $500,000 that insurance would kick in of portfolio size. But it's just something to keep in mind. You don't want a shady, tiny little broker that nobody knows about. The other thing is, of course, on costs. So you want to keep your costs low, especially if it's just a part of your portfolio. If you're just investing $10,000 abroad, now thankfully US has a lot of discount brokers, right? US came up with Robinhood, and that revolutionized a lot of investing around the world. So that's another thing to keep in mind.
So if you can just break it down for us, I know you started off with very compelling numbers in terms of how the S&P has performed. What is the previous market data? If we were to take it back 5 years, or if any interesting data points, make a compelling argument for why investors should be looking at this as
Yeah. So two things. One is going back to that quilt that I mentioned, the asset class quilt. The S&P 500 comes in, if I remember correctly, at number 3 over a 10-year period. So just below small and mid caps in India, you have the S&P 500. And below that is the large cap. So actually, you're doing better in the S&P. And yeah, there's diversification because you want a portfolio that is spread out, that you don't have country risk. People forget we had a lot of issues in this country, right? We had a pretty severe 2008 crash. We had a period of stagnation in terms of stock market from 2010 to 13. A lot of this rally has come in post-COVID. So, it really makes sense to have some part of your portfolio abroad.
But everyone here is talking about how India is in a sweet spot. We've got great things going for us. Yes, we've had challenges, but look how we've emerged triumphant on top. So why then should we even bother with looking at other markets when we're on a great path ourselves?
So although we are on a reasonably great path, the reason why everyone in India, and when I say everyone, I mean the financial services industry, banks, brokers, stock market gurus, go on and on about India's golden prospects, is because they have a stake in it. Every rupee that you invest through them, of course, they earn a fee one way or the other. Most of them don't have a stake in you investing abroad and you making some returns out of that. So take that with a pinch of salt.
Okay, fair enough. Now, there's multiple ways of investing, you said, in stocks and individual sectors, and then in ETFs. Can you just break it down for us as to what are the options available?
So for somebody who really knows what they're doing and they have their research done well, they can directly buy stocks abroad. For people who just know they want to take some exposure, not sure of which stocks, ETF is fantastic. And in the US, in fact, most active funds fail to beat the benchmark. So there, the case for ETFs is even stronger than it is in India. And the other beauty with ETFs in the US is they have a favorable taxation there. So ETFs is a bit of a no-brainer.
Would for the person who just wants exposure to US equities or the US markets without having much knowledge, would ETFs be the best way to go, or betting on the index itself, you think?
So the ETFs in most cases would track the index.
Tracking the index,
Yeah.
and that would be your most suitable option.
Yes.
Let's talk individual sectors. You did speak about this tech boom, and we've seen that really play out. The likes of Nvidia, Apple, US, the market caps are just staggering. Would that be the go-to sector, or are there any other promising sectors?
So the disclaimer here is that I don't track sectors and I don't have
Okay.
sector views.
Okay.
But one thing I've noticed is that in the narrative, there is too much focus on the tech stocks. They make the headlines, they look compelling. People forget that sectors, even in the US, have their rotation. So really for an ordinary investor, it makes sense to put the money in a diversified index and let that broad market take care of your needs.
And what about looking at actively managed funds for global diversification versus passively managed index funds?
So there's a very interesting alternative now coming up for Indian investors. And this has been a very long problem. There is a dearth of advice here. If you try to engage somebody in the US, it's prohibitively expensive. Who would do that?
Yeah.
So people just do DIY. They like Apple, they go buy Apple. Now the alternative that's emerging is Gift City. Already you have some of the marquee names in India setting up AIFs in
Yeah.
Gift City. Now the threshold for AIF is 1 crore. So it's not yet a mass product. Interestingly, for retail funds in Gift City, the regulator there has created a framework,
Okay.
and the recent budget again gave retail funds a bit of a missing parity that was not there earlier. So now it's kind of geared up for the first few launches of retail funds in Gift City, which would again take care of a lot of needs. And there are PMS providers. So to name a few, Saurabh Mukherjee of Marcellus, he has set up in Gift City a PMS. Some of the mutual funds in India, Aditya Birla, for example, they have started AIFs. Some AMCs have got the retail license also, like Mirai has got. So in the next couple of years, we'll really see this space developing.
And how can investors capitalize on this with Gift City?
So Gift City is treated as a foreign jurisdiction, much the same way as the US is. So the same rules around LRS, taxation, all of that applies. The benefit, however, is that you're dealing with Indian institutions, names that you know and you trust. So if you open an account, you're opening an account with, let's say an HDFC or an ICICI rather than some bank you never heard of. Brokerage, you're dealing with a name that you know. A PMS, again, the names that I mentioned, they are well known in India. So there is that added trust factor, and we know that ultimately, even though Gift City is treated as a foreign jurisdiction, it is under the overall umbrella of the Indian government and the constitution. So you have some protections built there for you.
I just want to stress on this because you already brought it up, but the fact that the Indian rupee depreciates at an average of about 4% against the USD, how does this impact equity investments in the US?
So it provides an uplift. If the standard stock or index returns 10%, your rupee returns tend to be 14.
Okay. Now let's talk about temperament, because I guess that's what the show is all about to a great extent. Behavioral patterns as well impact your investing habits. EQ plays a great role. And you spoke about a lot of the market men harping on Indian stocks to be the go-to to invest in. So what do you think will change the behavioral mindset from Dalal Street to Wall Street?
So the Indian market men, Dalal Street, thinks from its pocket, first and foremost. So until they have a stake in the overseas markets, they're not going to change that narrative. And actually, with Gift City, that might happen. As more and more of them have branches in Gift City, they may be a bit more balanced in their analysis.
What about big events like, say, the US elections, or for instance, we did have the global financial crisis of 2008? How does all of this impact investments in the US equities?
In much the same way that it impacts investments in India, um, of course, India has historically been insulated. So 2008 was in many ways more severe in the US than it was here. But I don't think there's any major risk that is there only because you're investing in the US. US is, the world's largest economy, very well regulated. So not an issue.
Apart from that corpus that one needs to have to be able to even invest in US equities, is there any profile of an investor that you would say should not venture investing in US equities purely or from a behavioral standpoint, maybe?
Yes. So one is somebody who has a small portfolio and not much understanding of global markets,
Okay.
because it takes sophistication to figure this stuff out. Somebody who's old and who can't deal with the compliance anymore, for sure. And one other thing to be pointed out here is inheritance tax.
Hmm.
So the US imposes an inheritance tax even on non-residents, that is Indian residents who have portfolios in the excess of $60,000 in the US. We are not used to it. We don't have this concept in this country.
Yeah.
So if you are a senior citizen, maybe you don't want to have too much of your portfolio there.
Okay, fair enough. Anything that can be done to, or any common mistakes do you notice that investors make when they're diversifying internationally, and that can be avoided?
Unfortunately, it's always been a fad thing. The last big wave of international investment happened in 2021. It was focused on US tech stocks and a boom among Indian new age brokers to offer US. Um, when people should have actually invested in 2022 when the US markets corrected massively. So I hope that Indian investors mature and don't see it as a tactical thing, but more a long-term strategic allocation.
So given that you're talking about it as a long-term strategic allocation, what is the actionable advice that you'd give someone to actually navigate these tax compliance and, these risks and invest in US equities in the most fruitful manner?
I would say start slow
Okay.
and find ideally a good advisor here who knows all of this stuff if you're not able to study it yourself, because it is difficult. It will get easier, but right now it takes some effort.
So a certified financial advisor is the way to go?
Yes, so SEBI registered investment advisor.
And say you want to do it on your own. Yes, you said there's a lot of homework involved. And say someone is interested, they have been tracking it. What does it typically look like? What do they need to track? What numbers do they need to monitor? What fundamental pointers do they need to keep a track of?
So in terms of the end stock analysis is pretty much the same whether you're analyzing Alphabet or you're analyzing a Reliance. If you're not going into that level of detail, if you're just doing an ETF, then thankfully you're investing for the long term, you don't really need to track it every quarter or every year even. But what you do have to really focus on is the compliance bit. That bit you should not mess up.
Okay. The rules are loud and clear, right? In terms of messing up with the tax compliance. It's out there in black and white.
Yes, thankfully there is no ambiguity
Yeah.
in the rules.
Okay.
But what can happen maybe is inadvertently you miss out on some dividend payment or you miss out on something, and then afterwards you get a notice. You don't want that to happen.
But what would you do if that does happen, just in a hypothetical scenario?
Sure.
What's your course of action?
Sure. So thankfully, over time, like I said, the budget and the income tax department, they have somewhat eased the rules. So, for example, now there's a campaign underway this year by the income tax department that people who missed out on their foreign income in the July deadline can file a revised return technically by 31st December, but now they've extended that date if I remember correctly. So by the date of the revised return filing, if you do include those things, you're okay.
Okay. Anything you are looking forward to with the upcoming budget that could be announced that would further relax rules, or anything that's on the wish list?
Permit me to segue a little bit into one other really important
Sure.
area here, which is ESOPs.
Mm-hmm.
So a lot of employees of multinationals in India who have never set foot outside the country get ESOPs in the US market, or what they call RSUs, restricted stock units. Or it could be that they worked abroad for a few years, come back, and they have those ESOPs sitting there. A lot of people don't even think about that or count it when they're filing their returns, and then they get notices. So again, you really have to, if you can't handle the compliance, sell off the RSUs when you come back to India.
Okay. And what about, like, say you did live abroad, and you have been given these ESOPs and you had a bank account abroad, and now you've come back and life here's going on hunky-dory. What do you do with that bank account typically? What's the best way to go about this?
So you can keep it for as long as you like.
Mm-hmm.
You just have to make sure that you report the balance correctly every year. You report the ESOP value correctly.
Okay. What about fractional investing in US stocks? I believe that's gained traction. Tell us what it's about.
Yes. So in the US, you can buy fractions of shares, 1/10 of a share, which you can't do here. That has been used to market US investing to people at the very lowest ends of the investor base in India. That if you have 1 lakh, then yes, you can buy fractions of shares in the US, which I think is okay for a small investor if they know their compliance well, if they know their international investing well. But like I said, ideally US investing or global investing is for somebody who has a sizable portfolio. So for them, it's not going to matter so much that fractional investing is available.
Although you did talk about a very small percentage actually diversifying overseas, sometimes it's also this herd mentality, this, how come you're not doing it? How does that play a role in investing and diversifying overseas?
Yeah, so as we discussed earlier, one area where it plays, unfortunately, a bad role is in the hype around tech stocks, Nvidia, for example. But another area which now, will increasingly grab attention is cryptocurrency. Because the taxation of crypto is so unfavorable in India, a lot of people will think that why don't I invest in crypto overseas? Now, this is a bit of a minefield because it's not yet clear whether you can do that under FEMA. And you can land yourself in trouble later on. So that's another area to be careful of the hype.
But it's 100,000 plus right now with crypto. I'm just talking about that the greed to jump onto that bandwagon, I'm sure must be there. Is that something maybe like in terms of conversations that you've been having with people that I want to capitalize on crypto, or is it still steer clear because there's no regulatory clarity? What's the sense you're getting? I just want to understand.
Yeah. So what happened after the budget which imposed the crypto tax is that the market essentially died in India. Hardly anybody did it anymore. There has been a bit of an uptick after this recent rally. Yet I don't get a sense of people going crazy just yet. And there could be shady operators that allow you to invest in India and transfer the crypto abroad. What I mean is that in most mainstream Indian crypto exchanges, you can't transfer them to cold wallets and you can't just move them to a foreign exchange. That's no longer permitted. But there is P2P transactions. And this is where people get into a big soup, because if you're transacting P2P with another guy who is got tainted money, and a lot of the money, unfortunately, in crypto tends to be money that's laundered, that comes from crime, because people want to get their money into Bitcoin and out. You become an unwitting victim in that. So that's something to be quite mindful about.
Okay. What about this, this fad that everything in the US is supreme, it's better, it's angrez, so I want to jump onto that bandwagon. That is a big part when it comes to Indians viewing things overseas. How do you think that plays into the psychology of even investing in US equities?
Yeah, it does to an extent, and that's where the shiny tech names come in. Um, I think it's not yet reached a very, very huge level of hype because of all of the compliance and difficulty in investing abroad, but it is a risk, yes.
So, given this huge hype that we've seen in tech stocks, I mean, any publication that you open is always harping about them. Is that leading to over reliance on some of these FANG stocks?
Yes, I think so, because people tend to invest in names that they've heard of. And the valuations of some of these stocks is crazy. And one thing that I mentioned earlier is the US share in the world market cap, which is around 70%, is at a insane historical high. It's not never been this much. So by some measures, actually the US is quite overvalued.
Oh,
So what you have to keep
yeah.
in mind while doing global diversification is the global part. That is not just the US. There are other geographies which might not have done so well in the past 5-10 years, but actually now might catch up.
Tell me what else one needs to be mindful of as an investor.
The other is to go through diversified instruments. So rather than yourself picking 3-4 stocks, a simple S&P 500 ETF would suddenly give you exposure to such a big swathe of the market.
What's the future of investing in the US equities? Do you see it picking up? Do you see it gaining traction?
Yes. I think now there's an awareness that's sinking in. One more point I want to add
Sure.
in terms of the bouquet of things you can invest in, it's not just US equities, there's also US bonds.
Mhm.
And the interest rates on those have actually ticked up quite a bit over the past few years. You're getting a good 4-5% on a US treasury. I remember I had a chat with my cousin who was visiting from the US recently. And I just asked her casually that what kind of interest you get on your savings account over there. You'd be
Okay.
surprised. She said 4%, which is what we get here,
Yeah.
right? On rupees, they're getting
Yes.
4% on the dollar. So interest rates have shot up there.
Wow.
It could be a good chance to lock in those rates.
So there's US bonds, you're saying there's ETFs, and then there's directly in stocks.
Yes.
Is there
And
any other?
oh yes, absolutely.
Tell
There
us.
are there are a lot of non-US stocks and ETFs that give you
Yes.
opportunities. So Europe, for example, so many of the world's biggest names, Unilever or Japanese companies, and they are actually cheaper than the Indian subsidiaries, many of them. So was one of the mutual funds in India, Parag Parikh, they had this strategy where they would go and buy the global parents at much cheaper valuations than the Indian subsidiaries.
Can you give us examples? You're talking about global parents being cheaper. Would you have any numbers at hand in terms of HUL, Unilever?
Yes. So
Or
one
any?
yes. So one company I remember historically, I don't know if
Sure.
that's the case now, is Maruti and Suzuki, the owner, was much cheaper than the subsidiary in India.
Neil, this has been super interesting, really, giving us a sense as to what lies outside of India and the opportunity that global markets like the US holds. Thank you for that. Lots of key takeaways. The fact that we have seen historically as well, last year, the S&P 500 emerging as a top performer. There are ways that you can invest in US equities. There's the ETF route, bonds, and then, of course, directly in equities. There are a lot of tax implications, so you need to do your homework before actually going ahead and investing. Penalties are very severe, so you need to ensure that there is absolute compliance. And do remember, the herd mentality is absolutely not the way to go. Do not jump onto the bandwagon of tech stocks, especially because everyone else is. And it's very important to consult a certified, unbiased financial advisor while making these financial decisions. Would love to know your thoughts as well on investing in US equities and what you thought of this episode. Do share them in the comments section below. We'll wrap it up on this episode. Look forward to the next episode. And don't forget, hit the subscribe button.